Hi, my name is Yosefa Huber. I'm a US CPA specializing in working with Americans living in Israel.
And I am Baruch Labinsky. I am a licensed portfolio manager and financial planner in Israel, and also managing money both here in Israel and in the United States.
We're here to talk about, in general, investing. And we're going to go through some of the thought processes that we go through when a client asks us, where should I be investing? So we're going to talk about the questions that we ask our clients, and then we're going to break down why we ask those questions, what the thought processes are. We'll go through some basic definitions about investing. Keep in mind, the goal of this is to give you ideas of what you should be thinking about. This is not personal investment advice. These are to get you started in a conversation with your advisor, your accountant, get you started doing research. What questions should you start asking yourself?
Right. What you should be thinking about through the process. Right. We're not going to be giving specific investment or, for that matter, accounting advice. There are so many factors that personalize those decisions. It just should help you with the initial thought process and how to think about it. But either you have to do the research yourself, or you have to work with a professional in order to really personalize those decisions for you.
We're going to throw out some of the questions that we start asking our clients, and then throughout this conversation, we'll break them down so you'll understand why we are thinking about these things. So the first few questions I ask my clients when they start asking me, where should I be investing? For example, should I be investing in Israel or in the US? So I ask them, how long have you lived in Israel? Or how are you within your first 10 years of Aliyah? That can make a difference. Are you a U.S. citizen? Are you mostly, that's what Baruch would be asking.
Right. So that's a critical question I ask, just because.
For sure. Usually people coming to me are U.S. citizens. I only ask that if they have an unusual accent, just so I can clarify. Are you self-employed? So we'll talk about why I might ask that question. Also, how much do you have to invest? Where is your money now? Is it currently in the US? Is it currently in Israel? Is it currently in Switzerland?
We want to get an idea of when they're going to actually need. What's their time horizon for investing? Is it short term? Is this money that they are going to need for a home, or for a large purchase, or is it designated for retirement? We also want to get a sense of their financial personality as well. Even when somebody's coming to me to ask me about investment advice, so we have different types of clients. We have clients who want to do it themselves, and so we give them general financial advice that they can do it themselves. And we have the other client that really is coming to us because they want somebody else to do it for them. So it really, you want to find the right fit also when you're working with a professional, because there are lots of people who have different personalities, financial personalities, and you have to try to find the good match there.
Yeah, I think that's really important, is to find someone who's a good match for you. And all my favorite financial advisors are asking questions beyond how long-term investing do you need. They're trying to get an idea about the person's feelings about investing, because that makes a big difference. For example, some people get really scared if they see their portfolios going up and down. Even if they are in it for the long term, it stresses you out. Might not be worthwhile unless you can get over that with a little education.
Right. Sometimes it's harder to be honest with yourself, right? When you're thinking about investing, you might think, oh yeah, I could actually invest and be very aggressive, or yeah, I'm okay even if it's in the short term. But then when the market actually starts moving and you start losing money, or there's volatility, it's a very, very different experience. And especially because in the last decade or more, there are a lot of people who have gotten into investing. There are sites out there like Robinhood that have really enabled anybody to start off with very small sums of money even. And the market has pretty much been, since 2009, so we're looking at 13 years, pretty much straight up. So a lot of people have been investing for many years and don't really have that perspective of going through really hard times with investing. And so you got to be careful. You have to just be very careful to really understand yourself and if you're making all these decisions by yourself. So it's good sometimes to talk through with your accountant, with your professionals, with friends, even with other people who have more experience too, because they can give you a different perspective on things in the long run.
It's interesting that you bring up discussing it with friends, because it's not always my first bit of advice.
So it depends.
But it's interesting.
A lot of times you can get a lot of good information from your friends
You
because
really can, yeah.
again, you have to choose which friends you want to talk to. Nothing wrong with speaking to friends about investing too, and you can learn about things, but you got to be careful that you also are not just trying to take recommendations of what worked with somebody else and say, okay, well, it worked with this person, so it should work with me, right? If I get a recommendation of a manager or of an investment product from my friend, so that means I can trust it. That is one of the biggest
Right.
biggest mistakes that people make with choosing investments.
Yeah. So I find that one of the most challenging windows is people who are relatively new investing or savings, new in their savings career, and have, let's say, less than $50,000 to put away. It's pretty hard to find a professional. So I really appreciate your approach, that you recognize that not everyone can have, can have a full-time portfolio manager, and you have some options.
I think in general, like you touched a little bit on some of the questions that are very much related to profiling, right? Risk profiling and profiling where you are in your life, where you are in terms of your long-term finances. Are you in a stage where you're putting away money every month? Are you on the other side of the coin? Are you retiring and now you have assets and you have to figure out where you want those assets to be working working for you? So it's really critical to ask these questions and think about it of like where you fit in, right? Where you are on the life cycle investing, where you are in terms of risk profiling, where your personality is, right? Americans, I always tell this to Americans, Americans generally are more aggressive investors than Israelis and much more aggressive investors than Europeans, right? I will have, with a straight face, people come into my office and say, yeah, I don't think I'm so aggressively invested. I think I'm only like 80 or 90% in stocks. And that's like completely like,
It's pretty aggressive.
It is aggressive from an objective perspective, but Americans think in general stocks are the way to see long-term growth. Is not only like where your assets are, but also where your income is. Right? If your income is coming from the U.S., but you're living here in Israel, so then you might really want to have a much greater emphasis on shekel investing and bringing money over here. If you're retiring here in Israel and you have Social Security income and you have pension income and it's all in dollars, so you might want to have more of a weight into Israel for your available shekel investing. It's all based on creating a balance.
I want to start by sort of breaking down the U.S. And Israel tax and reporting. First of all, I want to remind you, I'm a U.S. qualified CPA. I'm not an Israeli CPA. I have a lot of experience in this area working with Israeli CPAs. But either way, you should find your own professionals who know your own situation. But I do want to clarify where my licensing is. But I will mention so that you kind of know where to start about Israeli reporting as well. We both focus our businesses on people living in Israel. U.S. citizens generally need to file a U.S. tax return every single year, reporting all their worldwide income. In addition to that, they usually have to also report all of their foreign accounts, foreign in this case being outside the U.S. Any accounts that they have outside the U.S. need to be reported on an annual basis. In Israel, you don't necessarily have the default that you have to report every year. So that's the first thing that I keep in mind is, so let's break down the questions. How long have you been in Israel? If you are a new Ole within your 10 years, if you don't know, please speak with someone who specializes in this area. If you moved to Israel before you made Aliyah or you visited a lot, it may start at a different date, but in general, if you are a new Ole within your first 10 years, you generally are not taxed by Israel on your investments that are sitting in a different country where when the income is coming from a different country. We're not talking about working remotely. We're talking about whatever is producing the income, the investment that's producing dividends or capital gains is sitting outside. Do you want to clarify that, Baruch?
Yeah, it has to be assets that are domiciled outside of Israel. So, it could be it's a stock or a bond portfolio in the U.S. It could be it's real estate. It could be it's a partnership. It could be any different type of asset that is going to be, that is located physically outside of Israel. There gets to be a little bit of a question if you would bring or if you would hold foreign assets in Israel. So let's say you had a bank or a brokerage house in Israel and you're holding foreign assets. You're buying a stock with, in the United States that's traded in the United States. I don't think that there's an exemption for that if it's actually held.
I don't think so. I've never heard of anything like that. I think the bank is required to withhold taxes. I would assume that it has to be in a brokerage outside of Israel. If you're holding Israeli stocks in a brokerage outside the U.S., you should speak with a professional, but I think that's from what I understand, from what I've heard, that would not be considered foreign income. So if you own Teva sitting in your, Interactive Brokers account, for example, that it's possible that you're supposed to be paying Israeli taxes on that.
Even if it's the U.S. based share that's traded on the U.S. exchanges in
Ask a professional, Israeli CPA specializing in international taxation, but there's definitely a question there. So don't assume just because it's sitting in a brokerage outside of Israel that it's automatically exempt from Israeli taxes. But in general, if you have a brokerage account that is outside of Israel, that is usually not taxed for your first 10 years. The same with real estate sitting in some other country. Not only is it not taxed, you don't even need to report it currently under the current way that I currently understand the current law. You don't have to even tell Israel about it within your first 10 years. So that's the first thing that I ask people.
Although there's been lots of discussion, they keep bringing it up that they would like Olim to start reporting because they kind of want to at least start hearing about where people's assets are.
In the US, that's the way things work. You report everything, and then you explain why each item isn't taxed. You have to start by reporting everything. So that's one of the first considerations. It's both the taxation of that and the reporting requirement. So before we even get into the taxation, if you have to add another accountant and another tax report to your annual reporting, that's going to be an additional fee. So you have to take that into consideration. Then if someone is a U.S. citizen, obviously there's the U.S. Taxation. So that's a pretty important thing to keep in mind. I think in this video we'll mostly focus on U.S. citizens since that's my area of expertise, but I think non-U.S. citizens also can benefit from some of the other things that we'll be defining and explaining. Are you self-employed? So why do I ask if you're self-employed? What I really want to know is, do you need to file an Israeli tax return? So it's not just if you're self-employed. There's a number of reasons you might need to file an Israeli tax return. If your income is over about 611,000 shekels, that's when we're recording this at the beginning of 2022, or if you already have other foreign income that you need to report anyway. So for example, someone comes to me and they already have, let's say, some Charles Schwab account that their mom opened for them, 30 years ago, and they want to know where they should be investing their money. Well, they already have a reporting requirement to Israel because of that. So that is going to change my mind. But if they have no other reason to file an Israeli tax return, then and they're past their 10 years, so they have to be reporting to Israel, then that's a big consideration. And if they're not investing very much, then they could end up paying more to an Israeli accountant to report their investments than they're actually making. So the reporting requirements are definitely a consideration. And it's just, I think a lot about the stress level, and just adding one more report is something you really want to think about. So I'm not just keeping in mind the tax rates, but I'm thinking, what reporting requirements is this investment going to add? What are you going to need to tell your accountant? And is that something you can handle? Is that something that is going to stress you out, or is that something that you can handle?
Are you mostly concerned about, like, within the 10 years, let's say if somebody was self-employed and they had to report here in Israel, so what are you more concerned about, like foreign investments or Israeli investments under that circumstance?
So for most American citizens who are within their 10 years, usually the dividend capital gains rates, general taxes on investments in the US, that tax is usually much lower on the US side. So usually anyone within their 10 years, and we'll talk about this in the examples at the end, I think it usually makes more sense for them to be investing in the US. It just simplifies things significantly. After 10 years, then we go through a lot of other questions which we'll discuss.
But if they're self-employed and they are reporting here in Israel, does it make a difference then for you? Does it impact?
If they're within their 10 years, no, I don't think that would make a difference. No. I mean, if let's say they're at 7 or 8 years, then yeah. I mean, how much do they want to be moving their money around? If all their money's sitting in Israel and they're at 8 or 9 years and they're not self-employed, then yeah, I think it's not too early to be thinking about what they're going to need to be doing with their money in another 2 years. So it's worth considering.
What about new money? Would you also tell that couple within the first 10 years that's working here and earning shekels, should they convert their money to dollars and then send it to the US? Because that technically then is money being invested outside of Israel where they won't have to pay taxes on it here in Israel. Do you recommend to do that?
If it otherwise makes sense for them, I mean, what kinds of fees are you looking at when you add up transferring the money, converting the money? You're still less than 25%.
Yeah, well, but the 25% is 25%
tax. That's what I'm saying. Tax
gains, right? So
right, of course.
So right.
You're
so
right.
So
It's 25%.
If they're earning, right, if they're being conservative and they're trying for a 5% rate of return, so that 25% of that will be 1.25%, right?
Okay,
so if they're doing it for the long run, like for many years, even 5 or 10 years. So then a 1% cost or even a 2% cost to convert the money into dollars is probably reasonable, because you'll be saving that amount on taxes, especially if you are trying to invest a little bit more aggressively and let's say you're trying for an 8% rate of return or a 9% rate of return. So then the savings and taxes is higher. You will pay the conversion fee on this side and on the other side also. Right, the 1 to 2% here, and then the other way also when you bring it back, and then you have the currency risk. So, but if you're doing it for not like a short period of time, it could be worthwhile. I think the reason why most people that I speak to don't want to do that is just because of the hassle involved. If you have to kind of collect money here on a monthly basis for a number of months or a year, and then convert it, and then transfer it internationally, which can be a pain. It's work.
But hiring an Israeli accountant if you don't already need one, or giving your US accountant all the details of all of your buys and sells in Israel, those also,
Oh, correct.
so another question I ask is how much do you have to invest? And I want to know that because I have notes on different financial advisors I've spoken with, and most of them have minimums. So that's pretty important. So if someone says, "Oh, I have about $20,000 to invest," okay, well that wipes off pretty much everybody on my list of someone that you would hire long term to invest with. So that can limit their options somewhat. And it also makes, if someone has a few $1,000,000 to invest, then paying, 1 to 2,000 shekels for an Israeli tax return each year is negligible. So that makes a pretty big difference. What kinds of gains are we expecting is going to help guide me and tell me how much you can afford to pay on additional reporting and so not just taxes, but the reporting and conversion and management fees and all of those things. How much you have to invest really, I think, makes a pretty big difference in how much you want to spend on the reporting and everything around it. And so that would help guide me.
It will also, if you know how much somebody wants to invest, it will help us to classify or guide the investor in terms of what direction, in terms of what's available in general. Because a small investor, isn't going to be able to think about doing anything in the real estate field because you need much more significant amounts of money to be able to do that. But somebody, who's starting off, it's much more appropriate to look in, buying individual securities or funds, as we'll talk about in a few minutes. But it will help us kind of define what are all the available options for that investor.
So the next question, which I think we've hit on a lot already, is where is your money now? And why are we asking that?
We have to balance. We have to put a plan together. We have to think not just where your money is right now that you want to invest, but where it fits into your general plan, right? If you have all of your assets in X and now you're coming to invest again, so an advisor will oftentimes say, okay, we should be looking at doing something a little differently. We should be diversifying you. Maybe the currency diversification really becomes a real critical issue for you. Maybe country risk, maybe different asset classes out there. So you have to always put it in a context when you're thinking about making a new investment.
So I think you brought up a lot more subtleties that are beyond a lot of things I'm usually thinking, because a lot of my clients just want to know. I mean, if you look at some of the Facebook groups, it seems like one of the most common questions is, how do I get my money from here to there? And so where is your money now, and where do you need your money? While it may not affect your actual tax rates at all, or where you're taxed, it's possible that it won't even affect where you're taxed, because where the physical cash is not what determines the taxation. But you need your money to be easy to use when you need it. So if you're planning to buy a home in Israel in the next year, that may mean maybe that you don't want to be moving your money to a U.S. brokerage. Maybe. If you already have all your savings in the U.S. and you have a remote job where you're earning money into your U.S. bank account, then that seems like a pretty good reason not to bring significant amounts of money to Israel. I'm not saying that's a defining factor. Nothing we're talking about is a defining factor at all. It's all. There are a lot of cogs. There are a lot of moving parts. So we're just these are different things that we're thinking about. So getting back to the reporting, I just want to clarify what we're talking about. I kind of say as a rule of thumb that, I mean, this isn't a rule, but in general, what's easy on the U.S. side is harder on the Israeli side. What's easier on the Israeli side is harder on the U.S. side. So what do I mean by that? For someone who's past their 10 years of Aliyah, so someone who needs to report completely to both countries, if you invest in a U.S. brokerage, that usually makes your U.S. taxes easier. I'm not saying tax rates are less, but it makes it easier. You get a 1099, and the 1099, that's the tax form that you get from the U.S., and that generally shows your accountant exactly what needs to be reported. If you have an Israeli brokerage, you get a Tofish Shmona Sheish Shevet. It's Form 867, which shows your taxable income and tax withholding according to the way that Israel calculates it. And depending on your accountant's position, that could make your U.S. taxes more complicated. At the very least, but I recommend this to everybody, I think everybody who's living in Israel should have a U.S. licensed CPA or EA, a licensed accountant in Israel, someone who specializes in working with people in Israel. So it should be easy for them to read that form. You shouldn't need to be translating that form for somebody, some U.S. accountant, because if you're translating it, it shouldn't be, in my opinion, it shouldn't be up to you to figure out what on that form is taxable. It should be up to your accountant to figure out what's taxable, reportable. But there are some different opinions, and my position is that every single individual purchase and sale needs to be reported separately. And I may be in the minority among accountants in Israel, I'm not sure, but that's more work. It is more work, so it does make things, if you're investing in Israel, especially if you are actively buying and selling various things, it will make your U.S. taxes more complicated. All the more so if you invest in funds, which we will discuss shortly.
Right. Is there any situation where you would use the 867 and base somebody
dividends
for dividends?
So I look at a few things, but generally, the way that I understand the law is that when you have a covered security, you don't need to report all the details. When you have an uncovered or non-covered security, you do. So what's the difference? A covered security, and stop me if I'm wrong, a covered security is something where the brokerage has reported both the proceeds and the cost basis to the IRS. So in a case like that, you could have 1 million transactions a year, and your brokerage has already reported every single one of those to the IRS. And so when you do your taxes, you could just put the lump sum on there, and that's going to match the IRS records. But when you have a non-covered security, my understanding is that you're required to write each one. I respect the people who don't. Many of them have more experience than me, and they have good reasons. But based on my research, I believe that each one needs to be covered. So that's not by any means a reason to switch accountants or anything. You can discuss it with your accountants if you have questions. I'm not by any means saying, one is definitively not acceptable. But I won't do the lump. I won't, for example, if you have investments in Bank Mizrahi, some accountants will just write Bank Mizrahi and then the total proceeds and the total original cost. But I wouldn't. I would write out each individual stock or bond or whatever investment is you sell. And if it's a fund, it requires a lot of extra reporting, which we will discuss.
Interesting.
Yeah.
Yeah. So then, it definitely, if you are reporting in every individual transaction, so the accounting tax treatment of it, I think in my mind at least, becomes much more significant for the investor to be thinking about, right? Mm-hmm. Do they want to be investing in the U.S.? Do they want to be investing here in Israel? And how if they would want to invest here in Israel, how they would go about investing? Because you could sign up to work with somebody and then all of a sudden find that they're actively trading your account and they're doing well, but they're creating hundreds of transactions for you, and the amount of work that not only your accountant but you also personally will have to do it in order to gather all this information can be a lot of work.
Yeah.
So
it's also a decision. You have to find the right accountant for you. If I'm speaking with someone who's considering my services and they are actively trading, I'm not going to, it's no secret that this is the position I take, and I will let them know that other accountants won't, and that may affect my fee. So it's important to find the accountant that works for you. You would be using my services if you agree, of doing really, really crossing all the T's and dotting every single I. If you want to do something a little bit more efficient, you're willing to, whenever you appreciate that position, you wouldn't be using me as an accountant. So that's okay.
Does that include American securities that are bought and sold in an Israeli bank or brokerage account?
Any security where the basis is not being reported to the IRS, I would list separately. Yeah.
And it's not being reported to the best of your knowledge. You don't think that any of these?
I don't believe that individual sales. I have not yet seen, and I see a lot of IRS transcripts. I have not yet seen one where they report that. I generally only when an Israeli bank or investment brokerage, anything, reports to the U.S., I'm mostly only seeing dividends reported. Maybe I haven't seen enough of them, but I think the reporting is pretty spotty.
Mm-hmm.
Let's say you're past your 10 years. So a lot of people ask me, like, maybe you grew up in Israel. You don't have an exemption from reporting. And a lot of people think if they leave their money in their account, they don't need to report it. It doesn't work that way. Even if you don't actually take out the cash, there are a lot of elements of income that are still taxable on an annual basis, both to the US and Israel. So we're going to break down some of those definitions. So what is a dividend?
A dividend is a distribution from, again, please don't quote me on it from a definitive perspective. You can go to Investopedia if you want to actually get an official. But the way a dividend is generally a distribution from an asset. It could be a partnership or a stock, and they are distributing part of the profits.
Hopefully.
Generally, it's the profits that they are distributing to the owners, right? So if you own a stock, you are owning a percentage of a company, and then the company might decide at a certain point in time that they want to distribute part of the profits to the owners. So they will distribute a dividend, right? That will come from cash flow, from profits, and it has its own unique accounting, taxation, right, which is different than interest, for instance, right? It could be interest income, might be from a bond where you've given money to a company for them to be able to use, and they are going to pay out a certain amount of interest to you, and that's also taxed a certain way. Dividends are taxed also in their own way, and they have their unique taxation, in Israel and in the United States.
A company, hopefully, because they made a profit, the company has a profit, and the board of directors can decide how much of that profit they want to pass on to shareholders. And you can go online and you can see the history of various stocks and funds.
There are different investment strategies that focus on dividend-paying companies, or sometimes you have a lot of retirees that might want to be generating income, and they don't really care what the value of the portfolio is, but they want to make sure that those companies that they're holding are paying out regular dividends so that they get that income and that they can live off of. And so companies are very sensitive to the dividend issue because people will buy them, will buy the stock just because of this consistent dividend.
So it's a piece of profit. It's your very, very tiny, usually, share of all the company's profit, as opposed to interest, which is money you are paid for somebody to borrow the money. You're basically lending money. So when you put your money in the bank and the bank pays you interest, they're loaning your money out to other people. They're borrowing your money. They pay you for that. Or a bond. You want to explain a bond?
Yeah, a bond is basically when a company would like to raise money So they can either go to like a private source, like just like a bank and take a loan, or what they can do is they can go out to the public markets and they can create a security where they are basically going out there and saying, well, who wants to lend me money? And so they go out to the public in general, and the public then buys this security, a bond, and that is giving the money to the company. And there are specific terms associated with that bond, which are very much, dependent on what interest rates are, what the risk level is for the company. The riskier the business that the company is in, they might have to pay a higher rate of interest in order to compensate investors for
Why
taking
would someone
that
choose
risk.
a stock
Right?
or a bond or both?
So oftentimes people will include, first of all, both bonds and stocks in your portfolio because it's a way of diversifying and, spreading out your risk among different asset classes and different risk levels. A stock, and again, there are many different types of stocks. You can buy, the most conservative type of stock in a company that is very, very consistent but is not going to make a lot of money, but it's going to keep its value and it's going to go up slowly. So it can be more conservative, but in general, stocks are more volatile and have more upside potential because it's based on the business. It's based on the underlying company and the profitability of the company. So if the company does really well, so the stock price will go up, people will want to hold it, and then your investment will also go up. A bond, in contrast to a stock, is called another, one of the terms that they use, it's a fixed income product, right? So it's going to have a fixed amount of income for you, right? You're giving a loan to a company and the company is promising you a certain amount of interest. That's fixed. You're not going to be able to all of a sudden, you bought a bond for 4% and the company does great. It's not going to skyrocket in terms of the interest. Now, bond prices do go up and down in value in the interim, meaning before the company has to pay you back your money, bond prices do go up. So people sometimes will buy bond prices at a discount and try to earn more money like they would with a stock in a more speculative level where they're trying to buy things cheap and then sell it at a higher price. But if you're looking at long-term bond investing where you're buying a bond and you're planning on holding it for the life, so you don't really care about what the value is. You care that the company is still going to be stable. It's going to be able to afford to pay you the interest and to pay you back your money, right? You're not so concerned about the ups and downs, and so that's why it's got a little less risk and a little less return.
Earlier in the conversation, you used the word aggressive a lot, and you've mentioned risk levels. Can you talk about what you mean by that?
Yeah, so it's really important to define the level of risk that you're willing to take.
Why would I want to take risk if I don't want to lose money? Why would I want to take any risk?
Because the risk is associated with growth as well. Meaning, you can, if you take no risk, so then I can tell you, you won't lose money, but you're not going to make money also. And people want to make money, and there are good reasons why you need to invest, right? Even just thinking about inflation and how if we don't invest our money, if we take our money and we put the money underneath, the proverbial mattress, and we are not doing anything with it, and that could be under the mattress or could be just be sitting there in your bank account. So if we have inflation, and even though inflation has been low over the last decade or two, if their inflation is now starting to come up, and I think in the United States in 2021 it was approaching 7%, right? And many places we're talking about that the real underlying inflation was actually even higher than that. So if you have money that's sitting in the bank and it's, it was 100 at the beginning and now there's inflation, so inflation now erodes the value of your assets. So you have to invest to keep the value of your assets. That's one. And the other reason why you need to invest is because most people are not necessarily saving enough money in order to sustain their long-term goals, their retirements, their large purchases. They need to have their money, their savings, also make some money for them over time so that they'll be able to afford those things, right? Now, if somebody is really risk averse and they are making a ton of money in terms of their income so that they can put a large amount into savings, they don't want to take a chance about losing it. So then they don't necessarily have to invest. And you don't have to be aggressively invested. You don't have to go into things that have a high upside potential because they're saving a lot. But most of us are not in that.
So we need to take the risk to get a higher
Most of us are in a situation. Yeah, you have to take some risk in order to see your money grow over time. And I'll emphasize that for most people it makes sense. Meaning, if you're willing to take some risk, and you're willing to, and you have a plan, a long-term plan, if you're putting money away on a consistent basis, so stocks and even bond markets and most assets will appreciate in value over time. And yes, there are outlying situations and there are periods of time where you're not going to make money, but over the long term, most of the time, the high percentage of time, most periods of time, you're always, you're going to come ahead by
So
being
when you
invested.
talk about an aggressive
You just have to
portfolio,
be-
you're talking about something that is more risky and with the potential for a lot more growth, and usually something that has a higher
Correct.
percentage of stocks as opposed to bonds. So a higher percentage of being invested in companies as opposed to being invested in kind of like loaning money where it's much more stable.
Yeah, on a very basic level, yes, correct. Meaning there's, the asset world is divided, between stocks and bonds, right? Now again, it's much more complicated than that in practice, right? There are options and futures and commodities and crypto and investing in currencies and everybody has different strategies in terms of how to use all these different types of assets, to maximize their gain and minimize the risk. But in general, yes, that's the basic categorization. When you go more into companies, more into stocks, that's a more aggressive portfolio, which has a higher upside, but also higher downside, right? And that's the risk element.
So I often work with people who have a portfolio in the US. I work with a lot of people who haven't been filing taxes and I help them get compliant. And they haven't touched their portfolio and they assume that means that it isn't earning anything. And they are sometimes surprised to see that it is. I'm not suggesting that ignoring your portfolio is necessarily the way to go, but just because you're not touching it or taking money out of it doesn't mean there's not taxable income. So it could, if it's invested in certain things, it could be earning interest, which means that you're being paid because you're holding bonds or lending money. It could be.
And you could be in different funds as well. You could be in mutual funds or ETFs, and they might be distributing dividends or might have, gains that they are distributing to you on a yearly basis, and you didn't have to do anything at all, and you still have that income that comes in. And
so, even let's say somebody bought you a share of Disney stock for your bat mitzvah, for example, you could easily be earning a couple dollars a year on that, which isn't alone going to give you a filing requirement, but it is something that should be reported. So let's talk about reinvestments. So let's say somebody's not touching their portfolio, but they have made a choice at some point when their portfolio was set up, I guess. You can maybe clarify how that works, that all of their investments, that all of their income is reinvested. So the brokerage fund is not sending them a check, or the different companies that they own stocks in aren't sending them a check every time they pay out a dividend. That money just goes into their account and is invested usually in the same thing, right? You want to explain how that works?
Yeah, so there are certain programs, let's call it, available that allow you to just have an automatic reinvestment, right? So they often call it something like DRIPs, a dividend reinvestment program, where even though a company will be distributing a dividend to you, but they're not actually cutting you a check or depositing the money in your account. They're distributing the dividend to you, and then they are purchasing for you more of that underlying share. And so yeah, you might not receive anything except for a notification, but there is still income there, and they're not taking off taxes to the best of my knowledge. So
if you earn, let's say, a $15 dividend from a company, they, instead of sending you a check for $15, they use that $15 to buy, I don't know, it could be like 0.002 shares back into the same company. And so you're not going to see the money, you're not ever taking out the money, but the IRS still wants you to pay tax on that $15. So you got to make sure, even if you're not touching that account, that you are checking and telling your accountant about. I mean, that's one thing that makes U.S. investments, U.S. brokerages a little bit easier for U.S. Taxes, is because they give you a 1099 that tells us generally exactly what we need to know.
Yeah, in Israel, we don't have those types of automatic reinvestment programs. So if Israel was actually, the company here in Israel was distributing a dividend, or there was a redemption of a bond, so it will come right back to you, and you'll actually see that in your account.
So let's talk about, let's stay and talk about funds a little bit at the end. I just want to touch on a few other, besides stocks and bonds, things people might invest in really quickly. So besides a bond, you could do a bank deposit or a CD. In Israel, it's a picadon. It seems pretty popular amongst people that have modest amounts to invest over short periods of time and don't really know what else to do with it. And one benefit of that for a U.S. citizen is that when you're investing that in Israel, it's not, I'm going to use the word problem, it's not a problem for U.S. taxes. We're going to get into some things that will term kind of complicated or problematic for U.S. taxes, but I do want to clarify it's not in any way illegal. It's just that you might easily be paying more in taxes and accounting fees than you'll actually earn. So none of this, it's not illegal to invest in any other things, it's just complicated. So a picadon, or a bank deposit, is the opposite of complicated. It pays off interest. That interest is reported to you, and depending on how your accountant handles it, usually relatively simple to report.
Right. And
very, very small.
Very small interest.
Yeah, you would make more money
Currently
overpaying your U.S. taxes and then waiting for your IRS refund, because the IRS is so slow. You'd make a lot more money than in a picadon. But for people that need help saving, they can set up that a certain amount of their money goes into the picadon every month or something, and so that it's an option.
And there might be good reasons why people should just get the money out of their regular account and kind of out of sight, out of view, and then you don't use it. It's like it's an important financial tool, which is just making sure the money is being put aside towards long-term investing, and
just don't completely forget about it when it comes time to filing your FBAR, because it still needs to be reported there. So I thought it was interesting how you said that Americans tend to be a little more aggressive with their investments, and to me it just seems like Israelis love real estate. Everyone has to own a home. Even some little slum apartment full of cockroaches, just they end up renting some nice apartment and they own some little, they all want to have real estate.
Yeah. Israelis like real estate, but I think they like real estate for a couple of reasons. One is they like the security of knowing that it's something I can touch, that it's a real property. There's a certain home buying type of culture that we have here. There are the type of Israelis also that are not buying local real estate here in Israel, but that are buying real estate in the US or in Europe or wherever else, and that's a different type of investment in my mind. At least that's the that's the person that's kind of, getting a recommendation from their friend about some kind of like, guy who has made them a lot of money, and they're being
I
much
meet a
more
lot of them.
speculative.
I meet a lot of
And
them.
because,
A lot of it is like a father will put money, invest their kids' money in something. My number one recommendation there would be, if you can't read English at all, maybe don't invest in the US. Please. Um, you have to be able to at least kind of read your tax return, read some of the letters they're sending you, because if you invest in the US, you will have to file taxes to the US if you're not. I mean, U.S. citizens always have to file, but if an Israeli invests in the U.S., they need to then file U.S. taxes reporting that investment, and sometimes it takes them a few years to figure that out.
yeah, so it's generally those people that don't have enough money to invest in Israeli real estate, like in a more expensive property, and they think, well, I can still get into real estate, and I can put a small amount of money and these properties in many cities in the United States, they can be
Mm-hmm.
very, very cheap by even worldwide standards. You can get very cheap homes, and so when you are working with people and they're marketing and they say that they can, make you a lot of money, so people jump on the bandwagon, and you really have to look into things. I like your definition. If you can't, read English, and you can't do any of your own due diligence to assess whether this is really a good investment. Is
Mm-hmm.
this a good place for me to be investing? Right? Who's
Oh,
really
I
making
work with a
money
lot
on
of
this?
people that don't
You
even have
need
a passport and they invest in the US, so they've definitely never seen this property. And then when I see the expenses, you see a lot of, I think one of the biggest expenses I see on some of these things every single year is eviction costs. So when people are talking about investing in real estate, just to throw some pros and cons out there, really very much my opinion. So a pro of real estate is if you're a U.S. citizen. Some of the other things can be more complicated tax-wise. So real estate, if you're getting rent, yes, you have to report on an annual basis, but you're taxed on an annual basis. Uh, Downside, usually I ask people when they're talking about real estate, is I say, do you want to be a landlord? And people don't think about that. And you don't, there are things that there are ways you can invest in the real estate market without being a landlord, but a lot of these people are talking about just buying a property for investment and renting it out, and they have no intention of hiring a manager. So do you want to be a landlord? What are some ways, though? Let's say we like the idea of the real estate market, but we don't want to be a landlord. What can we do?
Okay, so I guess I would divide it into two main areas. Okay, one is just that there are traded securities that you can buy over any exchange here in Israel or in the US, where you're buying companies that invest in real estate. So, you can have large real estate developers who are traded on the stock market. And so by investing in them, what you're doing is you're taking a bit of a bet that, oh, the real estate market's going to do well, because if the real estate market does well, so then this company will also go up and you'll make money there. There's also something that's called a real estate investment trust, a REIT, right? In the US and in many markets, they're much more popular than they are here in Israel. In Israel, there's only 3 of them, I believe, right now that are publicly traded. But a REIT will hold a combination of a lot of different real estate properties, and they will need to, by law, distribute a large percentage of the income directly to the holders of the underlying stock. So if you buy into a REIT, so you're going to get a large amount of the distribution of the income that's being generated from those underlying properties. Now, you still have the risk of what's going to happen with the stock price of that REIT, right? If real estate goes down in general, or if all the stock market is going down, so REITs will also go down, and so you have to really make sure that you understand if you're going to be investing in REITs, what your strategy is. Are you long term? Is it short term? Are you buying it because it's an attractive yield, like income, or is it because you think that the price of that REIT is very cheap right now and you want to get in at a good time? So that's one way to get into the real estate market in terms of through securities, through ownership of stocks and that have or own that real estate. There are also, and I would stress that it's mostly for accredited investors, right? An accredited investor, right, there's specific definitions both in the U.S. and in Israel in terms of what they call an accredited investor. It's generally somebody who has over a certain amount of income and or a certain amount of assets. The regulatory bodies basically want to see a certain amount of sophistication. They assume that, and it's always not always correct, but they assume if you have a certain amount of money or you're earning a certain amount of money, at least what you'll be able to do is hire the right professionals to be able to check things out for you. And simplistic way of looking at things.
So as opposed to a publicly traded stock, which has to, pass certain auditing and whatnot, which anybody can buy.
Disclosure requirements, right? And that's why anybody can buy a stock, and you can also buy a stock with a very, very small amount of money. If a stock is trading for $100 or $5, you can go and, again, forgetting the costs, and the transaction costs, but you can go and just buy $100 worth of a stock. But if you're investing in other types of real estate investments where you need to be accredited, so then there isn't going to be the same amount of disclosure and reporting requirements, but there are many, many groups out there, no shortage of investment companies that are organizing private investments where they buy properties and they're looking for investors, right? And come in with certain sums. Some of them, have higher minimums. Some of them have lower minimums. You're generally, even for accredited investors, you're not going to find many investments at all less than $50,000 or $100,000 each for like a limited partner to come in, because these companies are raising, millions of dollars generally. And so you can participate, and then you can come.
I think my recommendation there would be know what you're doing, know what it's called, because you could potentially be considered, meet the standards of an accredited investor. But if you're just investing what your Uncle Harry told you to invest in, and you don't actually even know what it's called, you're not going to be able to tell your accountant what you're doing. Then your accountant's not going to be able to tell you what documents they need, and it could be a mess. So make sure you know what you're getting into. Please do your own research. Just because your Uncle Harry made money on it doesn't necessarily mean anything to you.
Or speak with an investment advisor or somebody who can advise you about how these things work and what the risks are, right? These things are not risky.
And ask your accountant what, preferably in advance, what will you need from me? What information are you going to need from me about this? Because that can be a challenge when somebody invests in something they don't completely understand and they can't tell me what they're invested in. I don't know what to ask them for.
Do you deal with Israelis that are investing in the U.S. that are not American citizens?
I do. It's not my bread and butter exactly, but I have a handful.
Right. So that's also something really important for people to realize also.
When I'm saying this, I actually have one person in particular in mind who invested in, I think, some Florida real estate and didn't exactly know if he has a partnership or if, basically gave somebody some money. He has real estate in Israel, he has real estate there. You just...
Right.
So I don't even know where to begin. I need more information. So know what you're doing. My first question was for him, like, wait, you invested in this in 2020. I've been your accountant since 2018. Why didn't you ask me about this? So, if you're my client, I'd prefer if you get in touch with me before you invest. I don't charge my clients by the hour or minute or anything. So, feel free to send me, if you're my client, not everybody, if you're my client, feel free to send me a WhatsApp. Hey, I'm thinking about doing this. Should we have a talk? An email, anything like that. I'd much rather get questions that are irrelevant than not get a question that is relevant.
Right. And for non-Americans, it's really also important to just realize what you're doing in terms of investing in the U.S. because there are things like estate taxes for
Yes, yes,
non-Americans
that's a big issue.
if you're investing.
And they don't realize that they need to then file not only US taxes, but also Israeli taxes. A lot of people got into this, and I think it's less and less. It feels to me like it's less and less, but there's still a lot of people that think if they invest in the US, that's going to shield them from Israeli taxes. It doesn't work that way. Not only does it not work that way, but Israel doesn't have inheritance tax and the US does. So you could end up being hit with more taxes than if you had just kept stuff in Israel. So investing in the US could be the right option, but it's not going to keep you from being taxed and needing to report to Israel. But while we're just discussing different kinds of options, I do want to hit on sort of more like private lending. There's a few different kinds of private lending. For example, you could loan to a Tama 38 project, which is or like a, destroying and rebuilding or, any kind of renovation. There's peer-to-peer lending. These things you definitely need to do your own research, but the reason I'm bringing them up is because for a US citizen, they can be more simple than other kinds of investments and more lucrative, potentially obviously more risky, but more lucrative than a picadone in the bank. Because they're paying interest. So if you have something that's paying interest only, you aren't going to have some of the complications that you have with things that are paying capital gains and things that we'll talk about in a minute.
How are those loans, like, let's say to Tama 38, if do they run into the same problems sometimes in terms of, because they're often structured as corporations?
Yeah, so that's a whole different story. If it's structured that you would be a partner or have any sort of shares, it's different. You need to speak with your accountant. But even if the company you're loaning money to is a corporation, if all you're doing is loaning, if you're not getting any interest, you don't have a partnership interest, you don't stock, you're not, you loan them this amount of money and they tell you they're going to pay you X amount back at X date. Then the gain, it's not gain, it would probably be interest. Again, speak with your personal professional about the specific situation. But for someone who's looking for options that are interest only, it seems you'd think something like that could be more complicated. But for U.S. taxes, it does have the potential to be like, okay.
Yeah, but I also want to just stress for investors, because I've seen too many people lose too much money in these types of investments, that if you really don't know what you're doing and you don't know how to do proper due diligence to make sure the group that you're working with really is stable and secure and they know what they're doing, and that you're not just kind of putting your money into something and not really understanding the structure and where it is and where the risks are, please seek out financial advice about it, because there are too many people losing money in all these types of investments too, and they think, oh, I'm going to make a little bit more money by lending it out, but they don't realize, with that 8% upside potential, you also have a downside to be able to lose all your money too.
Yeah. How about peer-to-peer lending? What do you feel about that?
So peer-to-peer lending, there are four regulated, here in Israel, there are four regulated companies that have licenses for peer-to-peer lending. And they all have a little bit different options and structure of their products. I think that they're a good alternative for people, instead of putting your money in the bank and getting 0.01%, right? You can put your money in these types of companies and spread up your risk across a lot more lenders and up your potential earnings to 2, 3, 4%, even 5%. It can even be, they are higher risk, right? And they also are not like a bank, like you go to one of the major banks in Israel, they have liquidity. If you need your money tomorrow, you can break your picadon under most circumstances, or you for sure know that you have that security. These companies, right, have gates where they can not pay back, or they won't have the money to pay back, like we saw at the beginning of COVID, where we're not giving money back to investors for a period of time. And so you have to realize that there's risk. And if all of a sudden the market goes down, so people will also default more on those loans, and you become the lender, right? So if you do it in a smart way and you educate yourself and you understand what you're reading, and you make sure that you're doing it in a smart way, that it's, money that you can divide up among enough people and enough different assets, like different levels of security, right? And many times when you're lending money in with these types of companies, you can choose: do you want to lend your money to an A lender, a B lender, a C lender? People who have different credit ratings, and you'll get compensated for it, but you can also decide, I want to divide up my money among the different types of borrowers, so that I'm spreading it out and creating a more diversified portfolio. Walking onto one of those sites and just putting 50,000 shekels in with one, the most risky type of investor, and only doing it with one single investor, I would not call that prudent.
So the benefit for tax purposes is that, so a U.S. citizen, as we've mentioned multiple times, is going to have to file a U.S. tax return every year, most likely. But your average person living in Israel does not have to file an Israeli tax return. And why is that? Obviously, it's not because Israel doesn't have tax. It's because the tax is what we call withheld at source. So if you earn, let's say you have a job in Israel, your employer is withholding all of the taxes that they're supposed to be withholding and that you're supposed to be paying. And so you don't actually have to do anything in most cases. They send that money to the various taxing authorities. The same with your bank. If you earn, let's say you earned 4 shekels last year in interest in your bank, and they sent one of those shekels to the taxing authority, and you get a report that shows that. And so most things that you would be investing in Israel, such as the peer-to-peer lending, they're going to give you the same tax form that the bank gives you, a Form 867, and they'll show you exactly how much you earned in interest.
Interest
and they're
income,
withholding
if it's
taxes.
shekel-based interest income, I believe it's actually only 15%.
Right, good to know. Thank you for clarifying that. So you're in the U.S., you would be paying regular tax rates, so it's not preferred capital gains rates, but for many people I work with, that could be 0 once you have all your various credits, especially foreign tax credit. So there's a really good chance that in the US, you don't pay any additional taxes. In Israel, they already withhold taxes. So you're paying it, but you don't have to think about it. You don't have to do anything about it in most cases. They're handling it for you. And you get a report that, for anybody who is used to people, dealing with people living in Israel, is pretty clear for us to read. And it's one line on your taxes. I'm not going to have to call you back in most cases. I'm not going to be calling you and asking you to track down the basis and tell me the date you bought it and all that stuff. In most cases, I can report the interest that's being reported. So for simplicity, definitely you have to do your own due diligence and invest in the right things. But for reporting specifically, it does have that benefit of potentially being simpler than some of the other things. So let's go to something that is very complicated on the US side, and a big issue that if you hang out in certain Facebook groups, you hopefully have bumped into by now, which is something referred to as PFIC, P-F-I-C. It's an acronym. It stands for Passive Foreign Investment Company. And it is a big issue if you want to invest in an Israeli brokerage or any brokerage outside the US. So investing in a US brokerage keeps things simple because they're not, by default, you're not going to accidentally buy a PFIC, most likely. But in Israel, if you go to your bank in Israel, it's very likely that they might suggest something like that to you. And you want to keep in mind that if you're investing through a bank, a banker, I like to remind people, some people say that they've gotten good advice from their banks, but in general, just because your banker says this is okay for US citizens, I like to translate that as my branch allows me to sell this product to you, not this is beneficial and you're not going to have to pay a lot of taxes and accounting fees. So they're saying it's okay, meaning it is legal for me to sell this to you, not this is going to be good for you. So keep that in mind. Don't just assume that if your banker says it's okay, that it's a good thing. So what do you want to watch out? Yeah.
Let me just clarify, just like because you're mentioning about advisors also, just so people understand. In Israel, there are 2 licenses for financial professionals. There are investment advisors, and investment advisors in the country work almost predominantly for the banks. So you might go into your branch and get advice about a specific investment. Those investment advisors can only give advice. Technically, everyone who walks into the bank has to make the decision themselves. They can get advice about it, but they have to sign off. So if you have money with your bank and you have an investment advisor, you might find that they call you up every quarter or periodically and make certain recommendations. They are basically giving you advice, and the advice in most circumstances is advice that's being generated on a national level at the head branch, and it's kind of feeding down to the local branches as specific recommendations that they give over to clients. But the client has to make the decision themselves. Advisor cannot manage that money. They cannot make those decisions independently. So many times it'll really depend on the advisor. Does the advisor know anything about U.S. taxes? Do they know anything about international? Do they know anything about your individual circumstance or not? And so that's why the advisors in the banks, oftentimes they're not trying to look out for your general situation. They're trying to be a very specific cog in the system that they're giving you advice that the bank and the head branch is passing down. Now,
is there anything like any other Israeli professionals? It can be hard to tell the difference between official advice and Baba Maisas, and right. I mean, I tend to find Israelis will advise on things that they're not necessarily.
Yeah, exactly. And that's as opposed to a portfolio manager. So I'm a portfolio manager. So when we manage assets, so not only, I mean, obviously myself being an being an Ole, an ex-foreign national, that we're very familiar with the international issues, and we work with people, right, like Yosef here, who obviously is going to give people the right balance in terms of their U.S. and Israeli, but portfolio managers have a different level of fiduciary duty. They have to look at the big picture. They manage your money. We manage assets. We're managing assets independently of the client, meaning we define what their needs are, and then we are implementing that strategy that the client asks us to follow, taking into account, obviously, the fact that we know that our clients are Americans and that there are certain areas that we want to keep them away from. So it's really important that you just know who you're getting advice from so that you don't fall into the PFIC trap.
Definitely. So what is a PFIC? So let's break that down a little bit. So as we said, stands for Passive Foreign Investment Company. What is passive? Passive generally means that it's holding mostly both holding mostly passive assets or generating mostly passive income. So at least 75% of its income is passive, or at least half its assets are assets that are meant to generate passive income, like stocks or bonds or real estate. It's foreign. That's important. I see a lot of people asking about some U.S. mutual funds. Is this a PFIC? No, the F stands for foreign. And when we talk about foreign, we mean in this context, we mean outside the U.S. So if it is based outside the U.S., it is foreign. If it is based in the U.S., and usually you can tell by the security code. If you see the security codes with the letters in front of them, if it says U.S., that's U.S. If it says IL, it's Israel. So foreign and company. So company can sometimes trip people up because they think, I'm not investing in a company, I just have a Kranot Namanut or Tudot Sal. mutual fund, the fund is considered a company, or a partnership can be a company, a corporation can be a company. So if you have any interest in basically a group of investments lumped together, I think a group could even be two investments lumped together, that is likely a PFIC. So we mentioned the real estate investment trusts. And so if that is based in the US, not foreign, not a PFIC, based in Israel, foreign, it's a company that is set up for investing in real estate. So it is, assuming it does what it says it does, that would be a PFIC.
So an Israeli-based REIT that's traded as a single stock, like one invests in, like there are, let's say, REIT 1 that's like traded on the Tel Aviv Stock Exchange, and it's a company, but it's a stock. You're buying a single stock, but it is holding multiple investments. Is that any different than like a real estate, development company that also has different projects around the country?
I'm going to tell somebody to please ask their personal advisor about that. But to me, it sounds like a PFIC. I mean, let's talk about it. So if we break this down and discuss why I think it's a PFIC or why we don't think it's a PFIC, then maybe that will help people figure out other things. So what is it? It's a company, right? It's a trust in this context, I believe, would be considered a company.
Right. So, So again, I believe that like it's a stock, right?
Okay.
It's a traded stock. Underlying the trading stock is a company, just like any company that floats its shares on the stock market,
Okay.
where you're buying an ownership piece of that company, and then the company, right, can generate profits in lots of different ways, I guess. So
How is it generating most of its profits?
right. So I guess that would be the major difference between.
I mean, it's probably holding at least like 90% real estate, 100% real estate. So
Yeah,
more than
could be
50% of its assets would be held for investment. Excuse me. And if it's collecting, I don't know if it's collecting rent or it's selling the real estate, so it's collecting capital gains, so it would be all considered passive income. So at least 75% of its income is passive.
So I guess
To me, it sounds like a PFIC.
An interesting question, maybe for you, just is like, right? Normally, we call investing in stocks and bonds passive because you're not really doing anything actively. But the tax authorities, at a certain point in time, when you're involved enough as a professional in that field, they actually will turn you into no, that's not passive anymore, because you now have enough interest and you're now like kind of operating as a professional in the field. So I guess it would be like an interesting question of like, well, once we would say that this company really is acting as a professional, they are buying professionally real estate.
But you could say that about any mutual fund. Who does the mutual fund employ? It employs stock pickers or something. So what? So just because they're paid a wage to do that? I think if you look at the balance sheet, you're gonna find. I'm gonna keep my money on it being a PFIC, but I definitely encourage people who are interested in that to speak with their own personal financial advisors. If they don't, their own personal accountant. Sometimes people come to me and they want information, which I'm always happy to give to clients and non-clients. But they want information because their U.S. accountant doesn't know about these things. So you have two choices really in that case. As much as I'm happy to explain PFICs to somebody, you really should be considering two options. Number one, you need a new accountant. You need an accountant who understands PFICs, because if they don't understand PFICs, they might not understand a lot of other stuff about international taxes that are relevant to you living outside the US. Number two, don't invest in PFICs. You don't even touch it. Don't even think about it, because it's very complicated to report. So it's not illegal to invest in PFICs. It's just very complicated to report. So don't talk about investing in PFICs if you don't have a professional accountant who can report it properly. If you do, then you can consider it, and for a small percentage of people, it's sometimes the right decision. But if you're not using a professional accountant who understands how to report it, which is a specialty, it shouldn't be it's just not something you're considering. And also, I forgot to mention, actually, that is one of the questions that I ask people when they're talking about where to invest. Is I might ask, do you mind if I ask who's doing your taxes now? And if they're doing their own taxes and they are very insistent to keep doing their own taxes, that limits them because they need to stick with things that are very simple. Or, if they're using someone who can't handle the PFICs, or if they're using someone like me who insists on reporting every single stock and every single buy and sell, that also may make a difference in what's practical for them. So often you either are limited in your investing, or you need to pick an accountant who is more appropriate for your needs in that way. So it is complicated, but it's not illegal by any means. So what makes it complicated? So why is something like an Israeli mutual fund, why does the US care that if I invest in an Israeli mutual fund as opposed to a US mutual fund? So what does it look like, Baruch, what does it look like when I hold, for example, a US mutual fund? I get a 1099. I haven't touched it. I haven't sold the mutual fund. What is my 1099 going to look like? What's my tax form going to look like?
So I believe you're going to actually have attributed gains in the mutual fund. That means at the end of the year, the mutual fund is going to give over the part of the income that has been generated in that mutual fund by buying and selling activity over the course of the year. So, there's a certain kind of let's call it an investing trap that you have to be careful of when you invest in real estate, is that you can invest in a mutual fund, especially towards the end of the year, and actually see your mutual fund go down in value. You buy $1,000 worth of a mutual fund. Now it's worth only $900 because it's gone down in value. And at the end of the year, you actually will get a tax bill because the fund is looking at all their transactions over the course of the year when they distribute to the owners before the end of the year.
And it's not necessarily distribution, right? So let's say I have 0.001 interest in a mutual fund, and I'm not touching it, but they have hired people who are buying and selling various stocks, or even an index fund. They need to keep the index balance. So in order to keep the balance of their index, they are constantly buying and selling stocks all year long to keep that balance. In addition, some of the stocks that are owned within that mutual fund are paying off dividends. So I don't know. I can go online and find out where most of the portfolio is held, but I might not know exactly what's inside the fund. I'm not picking what's inside the fund for sure. I'm not deciding what they should buy and sell. Someone else is. But at the end of the year, I'm going to get a tax statement that shows that I have earned 0.001% of all the dividends earned from all the stocks in that fund, and 0.001 shares of all the capital gains from any stocks that they sold during the year. And so I haven't touched it, but they've reported to both me and the IRS exactly our percentages, exactly the share of income attributable to me, and I pay tax on that. If I have an Israeli mutual fund, or a mutual fund in many other countries, I don't see that on an annual basis. It all stays within the fund, and it's not reported to me as income, and the IRS doesn't like that. They say this is deferred income. You're deferring your income. You're not going to report it to us until you sell the fund. That's not fair. We want our money now. So they have a number of ways of kind of penalizing you for having that. So the default, if you don't do anything about it, especially if you've held it for a number of years and not realized it was an issue, is that when you go to sell it, you're taxed not only on the gain at regular tax rates, you don't get the beneficial long-term capital gains rates, but your tax interest over the entire period that you owned it. So they say, let's say you own it for 10 years, and they say, okay, well, you were supposed to pay us a little bit of income 10 years ago, so we're going to charge you 10 years of interest on that. And you're supposed to pay us a little bit of interest, or tax on capital gains and dividends 9 years ago, so we're going to charge you on that. And so it compounds, and so you have these interests pretty punitive. I mean, I would go as far as to call penalties. And there's actually, maybe 4 different places on your tax return where you're going to see extra income and gains and interest and other interest be shown on your taxes. And all the computations for that, if you've owned something 10 years and you're, putting money into it every year, that form alone can easily be maybe 15 pages of all the calculations. So you need to keep in mind that you're going to be paying an accountant more money. You may need to be paying more money to an accountant who's also more expensive. You're not going to, be able to go to your local, student accountant or something. It's very possible that you could pay the IRS more than you made on it, or at least very significant amounts. And you're not going to get a whole lot of credit for the foreign taxes you paid to Israel. So there's a significant double taxation component. So that's the default. That's not the only way they can be taxed. It's the default if you don't do anything else, if you don't make any other elections. If you know in advance, okay, I'm making an educated decision that I want to invest in this PFIC because why would I want to invest in a PFIC, Baruch, for example, as opposed to investing in Teva and SodaStream and
right. I
Elbit?
think the main reason why, and the main 2 ways of investing in these PFICs are through mutual funds or through exchange traded funds. Right? And the local exchange traded funds, they changed a little bit their definition in terms of how they worked. I think it's now probably 3, 4, 5 years ago. And I believe that they are really also considered to be PFICs as well. So those types of funds have a major advantage, especially for small investors, because you can put your money in one place and create a diversified portfolio without having to do anything, because you have a manager or you have your money invested in a diversified index. So there are significant advantages for the average investor, especially when it's a smaller investor and they want to start off. Israel has a very easy to use kind of system where you can set up 1,000 shekels a month as like an automatic buy of a mutual fund.
So you have diversification without having to think too much about it. In Israel, you have some element of deferred taxation.
Yeah.
As opposed to in the US, where you can easily be paying tax on something where you haven't gotten your money back. And if you're making enough money, that can hurt because you haven't taken the money out of that investment. Sometimes you have to sell securities just to pay the taxes. And also you could have very significant tax advantages, for example, with a Kupat Gemel LeHashka'a. The Kupat Gemel LeHashka'a is a private providence fund. It's usually offered by the insurance companies. And that also is not, in my opinion, not only is it a PFIC, but it's also considered a trust, which brings with it a lot of other complications. So those, though, have some pretty significant Israeli tax benefits. So they're very tempting, but for a U.S. citizen, very complicated. So the Kupat Gemel LeHashka'a, what's that?
What's the threshold for actually recording?
So I like to go by the lower threshold. I believe that the threshold is that if you have at least $25,000 equivalent in a PFIC, in a foreign mutual fund or something like that, then you must report it annually, even if there's no activity. If there's activity, you generally have to report it also, if there's any activity at all. However, there's a lower threshold that says if it's a fund of funds, then it's 5,000. And so I usually stick to that 5,000 number because most of these funds are holding funds. So it's something I would discuss with the client. It's something that, also is a question of, is this something in the past that you haven't reported? Or is this something going forward that you're thinking of investing in? So, our positions can be different there. So what if you really want a PFIC because you want to just invest in one or two things? You want that diversification. You can't have you for whatever reasons you don't want something in the States. You don't want to have a professional advisor. So what are your options then? Let's assume also, please, that you have a professional accountant, a professional U.S. accountant in Israel who can handle the reporting. So I would still say stay away from Kupat Gemel LeHashka'a because that has additional trust issues, in my opinion. Trust is in ne'amanut. But your average Keren Ne'amanut or Tudot Sal through your bank is reportable, and so either you can choose to report that when you sell it. And then all the gains when you sell it, or you can make what's called a mark-to-market election, where you report the gain on an annual basis. You still are not going to get foreign tax credit, and you still are not going to get the long-term capital gains rates that you would get with individual stocks.
Why don't you get a foreign tax credit though?
Because the timing isn't going to line up. You're not going to be taxed in Israel. There are some other more complications with calculating the foreign tax credit with a PFIC, but usually, for the most part, it's a timing issue. And but that is an option. Then you report the gain on an annual basis, and then that keeps you from being hit with more of the punitive taxes when you sell it. There's also an option, which is very rare, to invest in a qualified electing fund, a QEF. We would call it a QEF. And so sometimes people say, like, oh, it's not a PFIC, it's a QEF. No, a QEF is still a PFIC. It just gets you out of the default PFIC punitive taxation. It still gets reported annually on the same form. It still would be reported annually on Form 8621. Like other PFICs, there's just an additional box that you check, and it's reported on an annual basis. And so what's happening there is that fund, usually it's a fund that is designed for U.S. citizens or paying accountants a lot of money to report special for U.S. citizens, and it is reporting information like what you would get if you had a 1099. Not exactly, but basically it's reporting individual income components like would be reported to you if you were invested in the U.S. So benefits of that are that you can sometimes benefit from long-term capital gains rates. You aren't hit with any of that punitive interest. So you could hold it for 30 years and not be hit with 30 years of interest and 29 years of interest and so on. But you still need a professional accountant. So this isn't going to be an option for someone who's trying to do their own taxes, because you still have to file Form 8621. And so you have to make sure that it's still being reported properly. You're probably still going to have some additional reporting costs above what you would have if you just had bank interest or something. But you can definitely keep from having the more punitive taxation. My question with the what's that? Do
you get the foreign tax credit on that, or?
So I think there could be pass-through foreign tax credit. I'm not 100%, and I haven't seen. I think there's only one right now in Israel, through more. I haven't seen it yet, to the best of my recollection. I would think there's the capacity to have pass-through foreign tax credit. So you're not paying Israeli taxes, I believe, because you're not selling it. But if the fund is paying Israeli taxes or any foreign taxes, I believe that those, I could be mistaken, but I think that those foreign taxes can pass through to you. But my question with that is, right now there's only one of them. So there's not, in Israel, if you want to invest in one in Israel, there's not a lot of competition, and I know it's a lot of work to do the accounting. So what kinds of management fees, are being eaten up by all of that? And so, I mean, in theory, yeah, you could have this fund that's automatically diversified and you don't have the punitive PFIC stuff, but I wouldn't assume that there's no kind of hidden costs in there because it's a lot of reporting requirements. I believe it's managed, not managed. I believe it's reported. The reporting is handled by Philip Stein, at least at this date. And so, unless they're doing that out of the goodness of their heart for their clients, I think that's probably a lot of work, and that's got to be somewhere in the fund.
Yeah, so I mean, I don't know off the top of my head what the management fees are for that specific fund, but when I've looked at it as a mutual fund, it's not prohibitively expensive from a management perspective, as opposed to a whole wide.
How is it performing though?
It actually has done okay. It's done okay. I mean, it's 30% in stocks and 70% in bonds, more or less. That's kind of its mandate, like pretty conservative. It's done okay. Again, I don't follow it, on a day-to-day basis, so I don't really know.
I'd love to see more competition in the market. I think it's a nice option for somebody who's using an accountant who knows how to handle it. But I don't think a lot of times when I hear about it, it's from people that are trying to do their own taxes and they think this is going to be the answer to get out of all the complicated PFIC stuff. Yeah, it's a bit less complicated maybe in many cases, but you're still going to have to file a Form 8621 every year. I have to assume your accountant's going to charge you a bit more to do that. So you have to make sure that those additional costs are worthwhile. Okay. Thank you so much for meeting with me today. This was great.
It's really been a pleasure, Stefa. Okay.
Thanks.
Thanks
for your time.